I'm Mike Ward. If you're interested in financial markets and companies and investing, you've almost certainly heard of SPACs. SPACs stands for Special Purpose Acquisition Companies, and they have been around for a while, but they are recently new and have taken much greater space in terms of investment. So you can see here, for example, this chart from the Financial Times, which shows the value of deals which have gone through SPACs for quite a few years. It's not been that big. But recently, we're seeing billions of dollars worth of deal value going through SPACs. These are companies which are listing, going public, from private to public. So that begs the question. Well, first of all, here are some examples. You've probably heard of some of these companies, and they've recently listed the SPAC route. But what is it then that is wrong with IPO process? So initial public offers are the more traditional way of companies going to the market. But an IPO typically involves raising capital, and that can be a problem. Because you're asking the public to put up money for something that has been private and therefore there isn't much information typically about these companies, there are a lot of rules. And so raising capital involves obeying stock exchange rules, such as how big is the company? Stock exchanges don't really want to list small companies because they're not really of much interest to large investors. And so they've got some size criteria. They also want to look at historical performance. How long has the company existed? How has it been profitable? And so they've got a bunch of requirements. They also, for example, need to ensure that there are a certain number of shareholders. They want liquidity. The shares must trade. Therefore, if they're tightly held with just a few individuals, nobody's going to be interested in having a public market for them, and so on. So the uncertainty, though, mostly revolves around the pricing of these companies. Up until now, nobody knows what they're really worth. They've got cash flows and profits and assets and so on, but no, the market hasn't been able to actually appropriately value the company. And so the uncertainty is what's at stake here. You're going to buy shares in a public offer and you're not really sure what they're worth. And so investment banks typically are involved in this process. They understand the rules. They're going to take you to the market, and they're going to also spend some time trying to estimate what the share price will be. But sometimes they get it wrong. And sometimes you go to the market and you don't raise enough money because you came in too low, or maybe and it's oversubscribed. And sometimes it's the other way around. They come in at too high a price, and then they have to underwrite the IPO, and that costs them money. And so all of this makes it expensive. I remember years ago, I used to work for an investment bank, and IPOs were a very lucrative business for investment banks. They charge big fees because of the role they supposedly play and the expertise that they offer. So those are some of the issues. So let's dig into how SPACs work and what they are. Now, a SPAC is basically a company which is put together by a group of experts. These will be ex-bankers, investment bankers, typically people who understand financial markets, and their expertise is what gives this thing any credibility. So they get together and they put their own money in and invite special people, and then they raise capital through a public listing of the SPAC, the Special Purpose Acquisition Vehicle. And really what they're saying to investors is, we're going to go out there and find companies which are suitable for listing and take them. We're going to act like a merchant bank, an investment bank, if you like. And we're going to raise the capital up front, though, and you can be part of this. And so we're going to take that money and we're going to go out there and search for companies we think ought to be listed and will do well on a stock market. And this might take a couple of years. and you'll just have to be patient because we, may or may not find the right company. Markets can go up and down. We could have COVID, who knows? And once we've got it, we are going to be able to do a direct listing. We're not going to raise capital. It's not going to be there's no public offer. We'll have enough money. We'll meet the requirements of the stock exchange, which are much less onerous if you're not raising money through the listing itself. So we're going to do what is called a direct listing. And you will make some money because you're trusting in us. You're betting on us being smart at what we do, knowing the rules, and you're going to get in early. And essentially, you're going to give us, let's say, $10, and we'll guarantee you're going to get $9 back anytime you want to. You can sell your share to someone else. And but we're also going to take $1 of yours, and we're going to kind of put this into an option, a call option, which will value our own shares, the SPAC shares, based on how things are going. And this, if you're an American, would be called a warrant. And you might lose the value of that. But hopefully, because as we get closer and closer to actually listing some company that we've identified and getting it ready for the market, the value of this option, the call option, the warrant, will increase a lot. And that's where you're going to make your money. But there's some certainty you're not going to lose all your money on this as well. So that's quite attractive. So this is just an example from the FT. You can see they start off by talking about the SPAC IPO. This is the listing of the acquisition company. So early backers are typically allocated, let's say, $10 a piece, while other investors buy shares on the open market once the vehicle has been listed. The important thing is trying to get in early here. Money raised through the IPO of the SPAC is put into a trust. It just sits in the bank, basically. It's guaranteed. It earns interest. And it's split, as I indicated just now. A portion of that is like your guarantee. You're going to get $9 back, and $1 is converted into a warrant, a call option, which each shareholder owns. And then what happens is the experts in the SPAC go out there searching for a suitable company and getting it ready to list. And the quicker they can do that, the faster you're going to get a return on your money. And if they find something suitable and they get it ready, the call option portion of this will be worth good money. So you can see here, the deal is announced. We found a suitable company, and hedge funds are usually going to wait until this deal is announced, and then they're going to just exit this whole deal and sell their shares when the company's listed and so on. And the deal is closed. Investors are going to be now locked into this deal, but they will be able to trade their shares now once the company itself is listed. So if we just look at what's been happening in 2021, just to give you a sense of this, 235 US SPACs got together, and between them, they raised $72 billion. So this is, significant investments in SPACs now, looking for companies to list. And if you look at the data, 97% of investors exited the SPAC before the deal was consummated, just before the company itself was listed. Some of them, if they exited early, would have just got their money back. Sometimes the SPAC isn't able to find a suitable company. People get tired of their money sitting doing nothing. And so they take their $9 out, and that's, at least they get something back. So this is a company I'm showing you here. This is their website called Wise. Used to be called TransferWise. I use them. Maybe some of you do as well. It's really largely set itself up as being a currency exchange company. You can put in pounds and get out euros, and but it also operates more as a bank now. It's not that old, 5 or 6 years, I think, and they've done very well. And you can see here they argue that they're on average 8 times cheaper than leading UK high street banks, and faster as well in terms of actually doing currency exchanges. So they're listing at the moment on the London Stock Exchange, and I thought I would show you how they're doing it. It's an alternative to a SPAC. So Wise is doing an IPO on the London Stock Exchange, and let's look at what they're doing. So the key thing here is this is a direct listing in itself. In other words, they don't need to raise capital. That means the rules and requirements are already met or will be when they list. And so because they're not raising capital, makes stuff a lot quicker and simpler. And to help them with all of this, meet the requirements, that is, they've got 10 million customers. That's people like me who are already using them and who know them and who presumably quite like them. And they have sent invitations to their customers, including me, saying, would you like to become a shareholder? We're going to be listing on the London Stock Exchange. And we're going to be inviting you, if you'd like to put up some money, and we're going to auction this off. Not everybody's going to be able to do this because we don't need all of you. But if you win in the auction, you'll be able to subscribe right up front. You'll get a good deal, hopefully, if the share price goes up once it lists. No guarantees, of course. But we're also going to give you an incentive to hold on to your shares. If you do that, we're going to give you, I think it's 10% bonus or something at the end of the first year. So they're also tying in investors, which is quite a good thing, because you don't want people, kind of a pop and then everybody sells, as happened with Facebook and some other listings in the past. The other interesting thing about them, and this is kind of a necessary evil, I guess, is they've got a dual class share structure. The original founders and owners of this company obviously would like to retain control, and they get a better deal. They get more shares than you do, or more votes per share than you do. That's kind of the norm these days. So I hope you found that interesting.